Investors, the AAII, and also by the Los Altos Library. They very kindly provide us the room here and the facilities. My name is Fred Smith. I'm a registered investment advisor and a financial planner. I'm retired at this point. I'd like to keep it that way. I like that. And I've given you my email address up here for anybody that has any questions after the talk tonight or at any other point, or if you want to discuss any of these issues further. As I said, this is the fifth of a series of 9 financial planning workshops. The first 4 dealt with investment topics. Started off the fundamentals of investing, where we looked at various ways of measuring risk and return and risk-adjusted returns like Sharpe ratio and so on. The second one dealt mostly with modern portfolio theory and how to build a diversified portfolio. And in those we also showed how the individual folks should build up a personal investor profile, a PIP, to define, before they get into any investing issues at all, to define who they are and what's important to them, and also to write up an investment policy statement, an IPS. So those should be documented. If anyone wants to go back and look at more details on how to do that, you can get that from our website. The third of the series, Al covered as a guest speaker for that, because I was out of town at the time, and he did a session on computerized investing. There's some good access there to some of the websites that people might be interested in, including the library here. Anybody who's got a Santa Clara County Library card gets free access to Morningstar and the S&P website and Value Line, which is a very useful tool. And then on the fourth one, we got a fairly good discussion going on the pros and cons of active and passive investing, and how to determine which area you feel most comfortable in. Next 3, starting off tonight, we're going to be on retirement planning, and next one we'll be looking at your cash flow, and after that looking at safe withdrawal rates, and there's a whole session dedicated to that because it's a rather complex topic. And then we'll be doing Social Security and Medicare. And both of those are a lot more complicated than most people realize, and you have the opportunity to make some big mistakes if you don't get into a decent understanding of it. Finally, we end up with estate planning, and I'm not an attorney, and I'll be covering all of the non-legal aspects, the practical aspects of estate planning. Okay, so for today, retirement planning. I'm going to start off with the accumulation phase and try to give you some good reasons for starting early. And for a lot of the folks in the room, some of you, that'll be a good lesson that you still learn. But for the rest of us, it's mostly a lesson to pass on to kids and grandkids. But it really is important to start early. I'm going to spend a fair amount of time on the various types of retirement accounts, IRAs, and Roth IRAs, and 401ks, and all of that. There's a lot of background stuff there, and I'm going to go through it fairly quickly, but it should give you a reference document, as it were, to go to what are the pros and cons and the differences amongst the various plans. And we're then going to look at asset location as opposed to asset allocation. The allocation we took care of in workshop number 2, but asset location for tax diversification is an important topic, and we're going to spend some time on that. And then finally we'll wrap up with some of the estate planning issues that relate to the retirement accounts. As I said, I am not an attorney. I couldn't underline that often enough. So if there are anything that where these are serious issues for you, recognize that you can do some serious damage if you make a mistake, and I strongly suggest or recommend that you seek professional help for any major issues that come up, mostly on the topics we're talking about tonight, but also on some of the other ones later on. Any questions so far about what we're going to cover? Is everybody happy with the agenda for tonight? I should also say that this is clearly a workshop where I'm encouraging people to get involved to interact with this. I don't want to do a 2-hour presentation up here to a totally quiet audience, because that doesn't do you any good and it doesn't do me any good. So if there are any things you do not understand, any things that you'd like to be made a little more clear, please speak up. Anything you disagree with me on, by all means let me know about it, because we should discuss it before we go on. So this is an interactive workshop, and I prefer to do it that way. We're going to start off with a bright young kid, Alan, who's 20-something, and it's graduation day for him. He's just graduated from Prestige U with an advanced degree, and he's going to start work shortly at Giggle. I love that. And he just to keep the numbers nice and simple, Giggle's offered him $100,000 per annum. So that's who Alan is. If we fast forward 50 years, Alan will now be 70-something, and he's looking forward to a long retirement with his feet up and fishing or traveling or whatever, and he needs to know what does he need to do in that 50 years to have a good retirement. So the goal of retirement planning is obviously to accumulate enough assets between graduation day and retirement day to live comfortably after retirement day. So that kind of defines the accumulation phase and the distribution phase. During the distribution phase, Alan's going to obviously have some expenses and won't have the income, so the question is how does he cover those expenses? Have his normal living expenses, of course. His medical expenses may go up, or I say probably will go up as he gets deeper into retirement, because that's one of the things that where the expenses increase at a greater rate than inflation for most retirees. Long-term care can be an issue, because that can be a huge expense if he hasn't planned for it. So that's something he needs to look at. But just using very, very simple rule of thumb, which you very often hear, is that you should plan on spending in retirement 80% of your salary, of your final salary. The reason it's only 80% is because you're no longer obviously making contributions to your retirement plan. You don't have to commute daily, you don't have to dress for work and all the rest of it, and you're not paying the Social Security taxes. And you may or may not have lower income taxes. That's why I put the question mark after that. Most folks do their retirement planning on the assumption that their income taxes are going to be lower. That's not necessarily true. There's what I call the curse of the working spouse for those folks who have retired themselves but have a spouse who's still working. And you may find that the benefits you were hoping for from lower income taxes aren't nearly as great as you'd anticipated. But this is only a rule of thumb, and we're going to be talking in a later workshop about better measures. But just for tonight, we're going to go with the 80% of salary. So we assume that Alan's going to need $80,000 in today's dollars. I'm doing everything in today's dollars just to avoid doing all of the math work. So where's Alan going to get his $80,000 from? There's the traditional three-leg stool where we have Social Security, a corporate pension, and then the rest of it will be from his retirement portfolio. Now, not everybody obviously has all three legs of that stool covered, but that's what you look at first. We're going to assume for the time being that Alan's going to get $30,000 per annum from his Social Security benefits. We're going to assume that Giggle does not have a corporate pension plan, so there's nothing coming for that. And so Alan has a shortfall of $50,000 per annum that he has to make up from somewhere. We're going to be talking in a later workshop about safe withdrawal rates and so on, but everybody is probably familiar with the initial rule of thumb that you can take 4% of your retirement portfolio out every year safely. That goes back to a study that Bill Bengen did in the mid-1990s. We're going to be talking about that in detail later, I guess in 2 months. But for the time being, let's assume that the 4% is a good number. That would mean that Alan's going to need $1.25 million to fund his $50,000 per annum. The problem with that assumption is that Bengen's 4% rule was put together in the middle of the bull market of the 1990s and may be overly optimistic today. The other problem is that when Bengen did the study, he assumed that everybody was going to retire at age 65 and they would have a 35-year retirement plan to age 100 that would cover everything that they would need. 50 years from now, that's probably not a good assumption for Alan. You know, already our longevity is going up. I'm not sure what the numbers are, roughly 1 year every decade or something like that. The latest numbers that I've seen, well, it varies a little bit depending on whether you look at the Social Security numbers or the actuarials that go with some of the investment companies for any of their life planning or life insurance and stuff like that. But typically, a 65-year-old man, most of the numbers say, can expect to live to about 84, 85, and women a couple of years longer. But you know, by the time Alan reaches his 70s, he could well have a lifespan expected to go out to well over 100, maybe 120 or something like that. So I'm saying that it's probably not conservative enough. It's a little too risky to use Bengen's 4% rule for something that would occur 50 years from now. So to be conservative, you know, as I said, we should probably use a 2% withdrawal rate for Alan, and that therefore he needs a $2.5 million portfolio when he retires. So the question is, during the accumulation phase. Yes, we have a question.
So with $2.5 million, how does that relate to retirement incomes and non-retirement incomes? Isn't the tax impact very different?
The question relates to the $2.5 million that Alan needs for his for the distribution phase for his retirement. Is that going to be in taxable accounts or IRAs or some other tax deferred? I'm not making any assumptions on that now. I mean, these are mostly just approximations. Yeah, when we get into a little more detail, we will be looking at the differences between, in fact, later on tonight, we're going to be covering a lot of the differences between tax-deferred accounts, tax-free accounts, and taxable accounts. But yes, sir, you're right. It does make a difference, and I'll admit to glossing over a little bit here, and just for the sake of simplicity. Okay, so on retirement day, Alan's going to need $2.5 million, and the question is, where does that come from? How do we get from zero on graduation day with nothing in the bank in the savings account up to $2.5 million on retirement day? And if we assume that Alan's going to start saving at age 35, I mean, if he's in his mid-20s, I don't know any folks in their mid-20s that start saving for retirement right away. So I'm going to give Alan a decade to get his act together and get his trip around the world done and get his hotshot sports car and all the rest of it out of the way, and you know, burn off some of the testosterone. And by age 35, he's seen the light and figures he's ready to start saving for retirement. So at age 35, he starts, and he continues up to age 70. In other words, he's got inclusive. So there's 36 years of contributing to his retirement plan. And if he's saving $15,000 per annum, this is what the cash flow would look like. And you've got 36 contributions to his plan for a total of just over $500,000 in contributions. And I'm assuming a conservative 7% per annum growth rate, but you can make whatever assumptions you want here. You get comparable numbers. But I'm just doing this for the sake of comparison, later. You'll see that at age 70, Alan has just over $2 million in his savings in his retirement portfolio, which is almost enough. It's just about enough to cover what he has calculated he needs for his retirement. So if you look at it graphically, this is what it would look like. He starts off at age 35 with zero, and there's this nice smooth curve where he's invested at 7%. The implication here from the nice smooth curve is it's a constant 7% per annum, but obviously there'll be jiggles on it in real life. But he's going to end up with almost the $2.5 million he needs at age 70. Now we want to meet a buddy of Alan's, and we're going to call her Betty. And Betty is the same age as Alan, graduated at the same time, and she also works at Giggle, and she's got the same starting salary as Alan. So the difference, though, is that she is a little more industrious, and she decides that she can start saving at age 25. But life catches up with her, and at age 35, she drops out of the workforce for one reason or another. So she's only putting 10 years of savings into her retirement portfolio, and from age 35 on, she's no longer making contributions. So this is what the contributions look like for Betty. By age 34, she put in her last $15,000 contribution, and she's got just over $200,000 in there. And she stops contributing, but the portfolio still compounds out to age 70 when she's got almost $2.4 million at the same 7% per annum growth rate. So she's only actually put in $150,000 in initial dollars. So her portfolio looks like this red one here, and you can see that for the first 10 years it's growing fairly steeply, and then she stops making contributions here. And then from here on, it's not quite as steep as Alan's, but she still comes out ahead of Alan, even though she only made 10 contributions. The fact that she started early gets her off to a really strong start. I think it was Albert Dodson who said that compounding is the eighth wonder of the world. You can see here that she's stayed ahead of Alan all along, even though from age 35 on he's slaving at putting in his $15,000 every year, and she's not, but she still comes out ahead. Now we're going to go to Charlie, and Charlie is doing the best of both worlds. He's a classmate of the other two and knows them well, and also works at Giggle, and he starts at age 25, but he continues making contributions all the way up to age 70. So his cash flow looks like this, and he winds up on his 70th birthday with $4.6 million in his account. Now he's put in $690,000, but at the 7% growth rate, he gets to just over $4.5 million. So that's the green line here, and you see way ahead of the other two. So the real takeaway from this, the message that I really wanted to get across here, was that it really is important to start early. And those of you who are young enough to heed that message, you should listen good. And those of you who have kids and grandkids that you want to influence, get them to start early. Even if they can't sock away 15%, you get them to put 2, 3, 5%, whatever it takes in, but do it early. If they have a paper route or something like that as young kids, get them to start. Any questions on this so far? Okay. Okay, so assuming that you start at a reasonable point, how much should you have in your portfolio? What sort of a reference, the benchmark, is there to measure what you have? T. Rowe Price has published these numbers. There's a number of different guesstimates out there. Some folks use different formulas, but in general, what T. Rowe Price is saying is that at age 30 you should have half of your annual salary saved, and by age 60 you should have 10 times your annual salary saved. They don't go beyond age 60. My own personal opinion is that age 65 you should have at least 15 to 20 times your annual salary saved. This is assuming that you're going to intend to retire at age 65. If you go with Bengen's 4% withdrawal rate, you'd need 25 times your annual salary, but that's based on the annual salary was based on your retirement expenses being the same as 1x your annual salary. I'd suggest that for the most part, 15% is the number that you should be shooting for. You don't have to start there, but you should certainly work towards that. I saw an article, I think it was today, this morning, which said that for millennials, the normal 10 to 15% is too low, and they suggested that since the growth rate going forward may be lower than what we're used to over the last 30 or 40 years. And since folks may be living longer, like I said, Alan's going to live maybe out to age 120, that people should be putting in at least 25% of their annual salary. Now, that seems to me to be a fairly aggressive position to take, but if somebody can do it, it's certainly a good goal. Michael Kitces, who's a well-known financial planner rather in the industry, has a goal of saying 30 times your current lifestyle expenses, 30 times your expenses, if you wanted to go with a 3.3% withdrawal rate. He also warns against what he calls lifestyle creep, and it's a warning that we should all heed. For any of the folks I talk about, Alan, Betty, or Charlie, whom they're working on and they get a raise from Giggle, they should not be spending that raise right off. It's okay to take a little off the top of that and spend some of it, but don't just immediately go out and get a hotter toy of some sort, whatever it is, a car or a trip or whatever turns them on. They should be sucking at least some of each raise away, and avoid building up your cost of living, your own personal cost of living at each raise, because that's what you're going to get measured against when you retire. And you want to avoid the trap of what Kitces calls lifestyle creep. Any questions? Is everybody asleep? Can everybody hear me out there? Okay, we'll move on. I'm going to get into what I call tax diversification here, because we're looking at a whole range of different retirement plans. Some of them are tax deferred, some of them are tax free, some of them are taxable, there's some taxable accounts in there as well. And some of these are ones that you can start and fund yourself, and some of them are done through an employer. And some, large employers, the 401ks and so on, tend to be corporate plans. They have to set them up, and it's fairly expensive. But there are other ones like the Simples and SEPs, the individual 401ks, which are done by small employers or even sole proprietorships. So we'll be looking at all of those. Those of you who were at the second workshop when we talked about building a diversified portfolio, we talked then about asset allocation as one of the primary forms of diversification. We've also since then talked about time diversification and dollar cost averaging or value averaging or so on. To my mind, what we're talking about here is tax diversification. It's the third of the big three in my mind for building and managing a diversified portfolio. The reason for tax diversification is because none of us knows what Washington is going to do over the next year, 10 years, 25, 30 years. To be perfectly blunt, if I were cynical, I don't think Washington knows what Washington is going to be doing next week, so I'm perhaps a little more cynical than most there. But it's too risky to build a strategy for the next decade, 2 or 3 decades, based on an assumption, any assumption on where the income tax rates are going to go, both the state and federal level. I think there's all sorts of indications that they're probably going to go up, but who knows? There may be other periods where that may not be the case. And one way to guard against the great unknown is to diversify. So my own personal suggestion and recommendation would be, with those folks who have retirement funds set aside, a retirement portfolio, to diversify it between some in taxable accounts, some in tax-deferred accounts, and some in Roth-type tax-free accounts, and be reasonably immune to the worst that Washington can do to you over the future. So we're going to be discussing these accounts in a little more detail. There's a lot of nitty-gritty numbers and so on to go through, and I've recorded them, but you don't have to memorize them. It'll be fairly obvious as we go through it which ones are appropriate for you and which ones you may not want to get involved with. We start out with the traditional IRA that everybody knows and loves, hopefully has done for the last 30 years or whatever. To fund a traditional IRA, you must have reportable income. You can only contribute to an IRA, to a traditional IRA, up to the maximum of what you've actually earned for that year. You must be younger than age 70 and a half at the end of the year to contribute to an IRA. Once you cross age 70 and a half, you can no longer contribute to a traditional IRA. You need to be careful with the wording on the next bullet. It says, who is eligible to contribute to a deductible IRA? Anybody can contribute to an IRA, but for it to be deductible, your modified adjusted gross income, your MAGI, has to be less than $62,000 for singles and $99,000 for married filing jointly. And that's to make the full contribution. That gets phased out over the next few $1,000s, going to zero for singles at $72,000 and zero for married filing jointly at $119,000. The MAGI is the I have a question online, but I want to finish with the MAGI first, and then we'll go back to that question. The MAGI is the modified adjustment gross income. It's the actual AGI that shows up on your 1040, but there are adjustments made to that where they add back in certain items. The most frequently one that you run into will be so-called tax-free muni bonds and stuff like that, where you thought you're going to get tax-free income that's going to get added back in to your AGI to compute your MAGI, and that's where that number comes from. We had a question online.
Will you be explaining how non-qualified retirement plans are tax deferred?
The question is whether I'll be explaining why or how. Can we how non-deferred, how non-qualified plans work to a very limited extent. There's very little in here that I'm going to be doing that will cover the non-qualified, because some of them are pretty complicated. They're rather esoteric. There's some information on it later, yes, but it'll be minimal. For 2017, as for 2016, it hasn't changed. The maximum contribution to a traditional IRA is $5,500, and for those folks who are age 50 and over, you can make an additional $1,000 catch-up contribution to bring you up to $6,500. For a traditional IRA, the contributions are deductible on your 1040, and assuming that you meet all the eligibility requirements. The growth within the plan is tax deferred. Up to age 59 and a half, you can make withdrawals. I'm sorry, after age 59 and a half, you can make withdrawals, and they'll all be taxed as ordinary income. If you make any withdrawals before 59 and a half, you'll be assessed a 5% or a 10% penalty. There are some exceptions for that, but the exceptions are rather minimal. After age 70 and a half, you hit the required minimum distributions, the RMDs, where you must take a certain percentage out, and there's a government table I'll be showing you in a minute, which explains how much you have to take out to meet their requirements. And there's a real draconian penalty if you fail to do that. You're going to get tagged 50%, half of what you should have taken out if you fail to do it, as a penalty. So those people who have RMDs, who are over age 70 and a half, don't ignore the RMDs. You will find that most of the financial houses out there, Schwab or T. Rowe Price, Vanguard, Fidelity, all of these will send you reminders on it. Don't throw it in the trash. You better, they'll tell you how much to take out, and you need to follow. You don't, if you have multiple IRAs, you don't have to take out the RMD from each one individually. You can sum them all together under most conditions and take out the RMD from wherever works best for you. And I'll be talking a little bit more about that later, but what a lot of folks do is use that as part of their annual rebalancing. If you have an IRA at one place and you're not comfortable with it for whatever reason, you can roll it over to another financial institution, and as long as you complete the rollover within 60 days, it will not be taxed. You should be aware that if you're doing the rollover yourself, the IRS allows only one rollover per person per annum. And even if you have 3, 4, 5 IRAs, you can only do a rollover on one of them per annum if you do it yourself. And when I say you do it yourself, you basically write to them and you say, I want to close out this account, send me a check. You get the check and then you send it off to the new place. That is not the optimal way to do it. It is far, far safer to do a trustee-to-trustee transfer because, first of all, there's no limit on the number of rollovers you can do if you do a trustee-to-trustee transfer. What you do is basically write to the place that's holding the IRA and say, I want to transfer this to this new place, and here's the information. You two guys talk amongst yourselves and make it happen, but don't send me the check. I don't want the check to come to me. The check has to go directly from one financial place to the other. If you do it that way, then the IRS will let you do as many rollovers as you want. RMDs. You must start at age 70 and a half. That's actually not totally legally accurate. The very first one can be the year after you turn 70 and a half, but I don't recommend it because then in that first year, even if you're doing 2 RMDs in the 1 year, you have to do the one that's been deferred or delayed, and then you have to do the one for that current year, and it's probably not a good way to go in practice. So you should basically follow the simple rule of assuming that at age 70 and a half you start making your RMDs. You can go to the table to figure out how much it should be, or as I've said, most of the fund companies will send you a reminder and tell you how much you need to send in. If you're relying on the fund companies, be a little careful. If you have an IRA with Fidelity and you also one with Vanguard, they don't know about each other. You'd better be aware of that, and you need to cover both of them. Yes?
So the amount you take out is whatever the percentage is of the closing balance from December 31st?
Of the previous year, yes.
Therefore, it is taxed equal to the following.
Yes. Yeah. Oh, I'm sorry. I should have repeated. The question was if the amount that you take out is based on the closing balance on the previous year, and again, the mutual fund companies will tell you what that closing balance is. They'll tell you what the percentage is and give you the dollar amount. You have to take that out, and it would be taxed in April of the following year. You can. The question is, can you take it out? You've got the entire year. Yes, you can take it at any time during the year. Most people play it a little dangerously and leave it to the last minute so that they can have it still compound tax deferred to as long as possible. But if you do let it slide into December, don't forget about it and all the excitement of the holidays or whatever, and let it go over into January, or you'll really be stuck. But yes, theoretically, anytime between January the 1st and December 31st, you can take it out. The IRS is actually fairly generous in the percentage that they ask you to take out. Just as an example here, I said for somebody age 72, the joint life expectancy, the IRS goes to a table what they actually do is give you the joint life expectancy of 25.6 years. So they're going to make you take out 3.9% at age 72. But again, do not put it off. Make sure that you have a big red sticker on your calendar, because 50% penalty is a pretty serious hit. That's 50% of the amount that you should have taken out and failed to do. Yes, sir.
Most of the brokerage houses will normally compute the percentage of the amount, but will also set up a program by which they send you a check or take that R&D out by a certain date that you specify. If the brokerage house fails to do that, And who's liable?
The question relates to the fact that most brokerage houses will compute the amount of the RMD for you, and in some cases you can automate them sending you a check for it, having the whole thing happen automatically. The question is, who is liable if they fail to do that? You, sir. I'm sorry. I think you knew the answer already. The brokerage house is not going to take the blame. They'll basically say it's your responsibility. We'll try to help you, but it's up to you. Yes. The comment was that the IRS is a waiver form, and if you fill out the waiver form, they will very often forego the penalty. That's actually true. I think it's in the last 12 months or something that it's a very recent thing, and there are certain, I think they list a dozen or something standard conditions as to why you might have forgotten, a death in the family or something like that. And if you fall into one of their standard things, they have gotten a little more reasonable, and there's a good chance that they may in fact waive it. I'm not sure if that's on the list or not. I'm not sure if Alzheimer's on the list. Yeah. Yes. The question is, if somebody turns 70 and a half in November of this year, when did they start taking their RMD? To be perfectly honest, I don't know the answer to that. I think it may be, it's 70 and a half. I think it's 6 months after you turn 70. It's in the year that includes the 6 months after you turn 70 that you have to take the first distribution, I think. But check that. I'm not certain of my answer on that. There's another question back there. Okay. Yeah, for somebody with a birthday in October, they get until the following year to take the distribution. Yes. Any other questions? Okay. The IRS is it's a little confusing. If you go on the IRS website and you look up RMDs, there are actually 3 sets of tables on there. And it's easiest to understand if we start at the bottom and work up. Table 3 is the one that applies to most people. I don't know why they did it this way. Table 3 applies to the owner of the IRA as opposed to a beneficiary. It also applies to folks who are either unmarried or married with a spouse who is no more than 10 years younger. Yes, I have a question.
So this pertains to some information on previous slides. So you said something about the 2.5% withdrawal per year is what you recommend given increasing life expectancy.
I'm sorry, can you repeat the question?
I recommend 2.5% per year withdrawal from your retirement savings instead of the 4% because of the...
Oh, okay, no, I was you're getting back to the... Okay, yes.
So let's say that, based on that formula, they come up with a number that's 60 million that you just have in savings when I retire. How does that work for a married couple, for example? You double that? You factor that somehow? What is your...
The question relates to how you juxtapose the RMD values imposed by the IRS for these accounts beyond age 70 and a half and the amount that you would want to withdraw to cover your expenses. We talked earlier about the 4%, Bengen's 4% rule, or some variation of it. The answer is that one has got absolutely nothing to do with the other.
Actually, I wasn't trying to relate all of these. I was asking about the earlier slide.
Oh, okay.
So, if for a single person, the required savings to maintain that lifestyle is 3 million, how much would you increase that by for a married couple? That's my question.
Oh, okay. The question goes back. The question goes back to a slide, 10 or 15 slides earlier. If the required minimum distribution for one person is X percent, say 3%, what would be the optimal number for for a married couple? The proper answer to that is you got to get down with a pencil and paper and figure out what the expenses for a married couple look like. The rule of thumb would probably be the same thing. It would be 80% of what you had been living in up to that point, or the percentage that we're talking about for withdrawal comes from the total portfolio. If you're talking about the joint portfolio of both the husband and wife, then you would take that percentage of the joint portfolio. If it's a single person, you just have the portfolio for that one person, then it will be X percent of that. But we'll be covering all of that in a lot more detail on the, I guess it's March workshop, where we're going to be talking about safe withdrawal rates and the pros and cons of a whole bunch of different ways of doing it. So be patient, sir. Yes?
3.9% is only the first.
That's for somebody who happens to be age 72 at the time, yes.
But that keeps increasing every year.
Yes, absolutely. The 3.9% we showed on that was for age 72, and as you increase your age year after year after year, that value changes. I'll show you the table in a minute, the next slide. Table 3, as I said, is called the Uniform Lifetime Table, and that's for the IRA owner, and it's the one that most of us will use, whether we're married or single, so long as your spouse is no more than 10 years younger. Which sounds like a strange requirement until you look at Table 2, which is for the joint life and last survivor expectancy. I'm not going to come up with this, which is again for the IRA owner, but there are constraints there which say that the owner, if he's married, if the spouse is a sole beneficiary and is more than 10 years younger, if those apply, then the IRS gives you a slight break on the rate, the RMD rate. So if you have a married couple and one spouse is 12 or 13, 15 years younger than the other, the rate that's calculated for the older one is going to be a lower rate, slightly lower. It's not a huge difference, but it means that you're depleting your account a little more slowly. But for that to hold, the spouse has to be the sole beneficiary. We have another question from the web.
Does the percentage of compounding required as RMD increase or decrease with increasing age?
The question is, does the percentage for the RMD that's determined by the IRS increase or decrease with age? The percent increases. If you go back to this slide, we came up with the 3.9% by taking the reciprocal of the number of years. In this case, we said if somebody had a joint life expectancy of 72, that for that person, the IRS gives them a 25.6-year life expectancy, and the 3.9% is just 1 over their life expectancy, 1 over the 25.6. Next year, it's going to be 1 over 24.6 and 23.6, so on. So as the life expectancy goes down, the percentage goes up. And you see that on the table here. What I'm showing you here, I'm only showing you one table, the one that most people will use. And don't worry if you can't read it here, because I don't expect everybody to be able, at the back of the room, to read that. I just wanted to show you that, at age 70, the IRS is assuming a just over 27-year life expectancy for a 3.6% RMD. At the bottom of that same column, you've got age 85, and now you have an almost 15-year expectancy, but the RMD has gone up to 6.8%, almost 7%. I've only shown the table out to age 100, although I think the IRS goes out to 115, if I remember rightly, but I thought for the interest of practicality in the room here tonight, we'd probably all be happy with the 100. So at age 100, the IRS is still giving you, just over 6 years life expectancy and a 15.9% withdrawal rate. just in passing, it's got nothing to do with tonight's topic, but this same table is going to come up 2 months from now when we're talking about safe withdrawal rates, because some people use this table to figure, instead of using Bengen's 4% withdrawal rate, they use this table as a guide as to how much they can withdraw each year. And it's not a bad starting point. It's perhaps a little on the conservative side. But if at age 70 you're to pull out 3.6% of your portfolio and then have that increase as per the table as you get older, it's a reasonably safe way to do it. It avoids you making any huge mistakes. So just keep that in mind for a couple of months, and we'll get back to that. Any questions before what happened here? I apologize for the break, folks. We had some technical issues here, and I think we're back live. We're still working on getting everything set up the way we want it. I mean, some of the discussions we had in the meantime related to RMDs and the various situations in which they would apply. One of the questions was whether they apply to 401ks or not. I believe the answer to that is yes. The RMD does in fact apply with the same draconian penalty to a 401k. Okay, so we had finished with the traditional IRAs, and we're going to move on now to some of the other forms of it. A spousal IRA is almost identical, except that that it can be set up for somebody who has little or no income. The regular traditional IRA, remember one of the first rules was you can only contribute to it up to a maximum of either $5,500 or whatever your earned income was. For spousal IRA, they forego the earned income test. But again, the contribution limits are the same. The $5,500 with the extra $1,000 for those folks who are age 50 or beyond. And very often spousal IRAs get rolled into a 401k when things change or whatever. Yes, another question.
Why does retirees withdraw less than 4% per annum if the IRS requires withdrawals more than 4% per annum?
The question relates to retirees withdrawing 4% per annum to live on, I guess, or less, when the IRS can require them to withdraw more than 4% per annum. You need to be very, very clear in your mind that the one has nothing to do with the other. You withdraw whatever you need to live on, regardless of what the IRS says, and you must withdraw what the IRS says whether you need it to live on or not. If the IRS says that you must withdraw 4% or 5% or whatever the number is to satisfy your RMD, it does not mean that you have to spend it. If you need to spend it, that's okay. If you don't need to spend it, you can reinvest it wherever you want. The only thing the IRS requires that you do is that you withdraw it and you pay the taxes on it, and they'll be ordinary income taxes. Once you pay the taxes on it, they don't care if you take it to Reno and put it all on red, or if you want to go on a world cruise, whatever. It's entirely up to you. You can stick it all under the mattress, but it's got nothing to do with your, what you withdraw in the RMD has nothing to do with your living expenses. It just happens in practice that the forced RMD normally does get factored in one way or another into where your living expenses come from. But there's no reason why the value of either of them should be in any way tied, whether they should be tied to each other.
The two can be merged together, some people are doing.
Oh, I mean, it may well happen. The comment from the floor was that the two can be merged together. Yeah, it may well be that whatever the IRS requires that you withdraw happens to be fairly close to what your living expenses are anyway, and that's rather fortuitous. But if it's not close to it, it's up to you to deal with the two of them separately and make rational judgments on it. Okay, we're going to move on to a non-deductible IRA, and what that means is that is for those folks who did not meet the MAGI, the MAGI limit. Remember I said that in order to be deductible, you had to have singles less than whatever was 99,000. I don't remember the numbers, a few slides back. And for married filing jointly, you had to have income, the MAGI less than a certain amount. If you exceed that amount, you can still contribute to an IRA, but you can't deduct the amount. And the contributions will still go into the account, and the earnings on the account will grow tax deferred in all ways the same as with the traditional IRA. The after-tax withdrawals, or the contributions that you make, the after-tax contributions that you make, you can withdraw those tax-free because you already paid the taxes on it. Whereas with the traditional IRA, every penny you take out is going to be taxed as ordinary income. But with the non-deductible, where you're beyond the limits and you're paying the taxes before it goes in, the IRS recognizes that and will let you pull that amount out tax-free, the principal tax-free. Again, the earnings will be taxed, the ordinary income rate on withdrawal. In practice, this is fine, but in practice, you're going to be forced to keep track. If you do, in fact, if you've been making contributions to a traditional IRA and taking the deductible year after year after year, and then you make some contributions over and beyond that, non-deductible contributions, you need to keep track of what was deductible, what went in on a deductible basis, and what went in as after-tax dollars. And actually, the IRS has a form, I think it's 8606, that you have to file each year, where you explain, document for them what your deductible basis is and what your after-tax basis is. But just recognize that there are ways to make contributions to an IRA even if you do not meet the MAGI limit. And before I get into the Roth, are there any other questions on the IRA concept where you're making deductions that are generally tax deductible and then having the earnings grow tax deferred and then paying ordinary income tax on both the earnings and the contributions as it comes out later? Any other questions on that concept? Yes?
I'd like to put an expiration point on the end of your previous statement. You have to keep track of the non-deductible or the tax amount not paid to the IRS. You eventually can have to withdraw the money. Computer work is, it's not easy sometimes finding your employer get off and make on a tax right. And if you don't know that, you may not pay taxes on it, or you may be paying taxes on money that's already paid. Right, the money is going to get back. If you place your filing account where you exactly know every single year, you're employing, especially for all of these, it's exactly like that.
The comment from the floor was basically emphasizing the importance of keeping track of your deductible contributions and your non-deductible, because when you come to make the withdrawals, the IRS is going to want to be able to proportion which is which, and you need to have a really good record at that point, and you need to have that record even if your employer has gone bankrupt or all sorts of other things have gotten lost over the previous 20 years. So it's the responsibility of the IRA owner to keep good records on the deductible and the non-deductible contributions, because you may need them 30 years from now. Exact same argument. For all of your, the question relates to keeping records for any of these plans. I'm suggesting that it's important to keep really good records for all of your retirement plans, because you need to be able to sort out the deductible versus non-deductible contributions. You need to be able to sort out. You basically need to know what your cost basis is in the plan, so that when you come to make your the distributions from the plan, either RMD or voluntary distributions, you need to know what the cost basis is. And this can be 30 or 40 years later. So you need to be able to go back to what you did in 1970 and have records on that to know how much tax you're going to have to pay on withdrawals you make today. There's another question here.
So the form is contributions are all the
That's not totally, the question related to 401k contributions. We'll talk about that in a minute. We'll get to that in a minute. Okay.
They can only provide for the last 10 years. And for a person like me, I haven't kept the record.
The comment is from a lady in the group says she hasn't kept the records. She's thrown some of them away beyond 10 years ago. If you don't have the records, you're going to have to make a best effort to reconstitute them. And it may mean going back to the bank or going back to your company or whatever and trying to piece together what happened and when. But everybody just please note, it is important to keep those records. Don't throw them away. I think there's another question.
I just wanted to supplement these things. I mean, this thing was so bothersome because the regular IRS don't have to keep track of it because you pretty much pay regular taxes, and the Roth IRA don't have to keep track of it either. The only one you have to keep track of it is deductible money.
The comment was that for regular IRA, it's relatively easy to keep track of it because everything that goes into a traditional IRA, by definition, is going to be tax deductible. By definition, everything that goes into a Roth IRA, is going to be taxable, already taxed. The real problem does, in fact, occur if you start mixing them or blending them or have a mix of deductible and non-deductibles. But you still need to know, it's useful to know what years certain contributions were made, and it's useful to be able to dig up the history. Now, okay, we've got a bunch of stuff still to cover, so I'm going to move on. Roth IRAs are different in that you're funding the Roth IRA with after-tax dollars, but every dollar that you put in is going to be totally tax-free from then on, both for the earnings and also for everything that you withdraw from it. It will be on a tax-free basis. For that reason, it's great for the younger kids, for the millennials, because if they start funding a Roth IRA, at age 25, 30, whatever, this can grow for 50 years tax-free in their account. And it's also, as we're going to see if we get into the estate planning, it can even grow for maybe another 50 years. And the heirs, if they use that to pass it on to their kids or grandkids, it can continue to compound tax-free. And when it's eventually pulled out, there will never be another dollar paid on it. Now, I'm a little skeptical about the ability of Congress to keep their cotton-picking mitts off something like this for the next 50 years. I'm telling you, the way the law is set up now, I think there may be some, this is just Fred Smith talking, I don't know, I don't have any inside track in this, I haven't heard any rumors or whatever, but it wouldn't at all surprise me if they started doing some sort of means testing on what you can pull out tax-free in the future and so on. The Congress has a knack of doing this kind of thing and finding ways to get their hands on a little more of your money if they think you can afford it. Okay, so who can contribute to a Roth IRA? There are income limits on this for $118,000 for single taxpayers, and where you can make the maximum contribution up to $118,000, and then it's phased out up to $133,000 for single taxpayers, where it goes to zero. And then for married filing jointly, it's $186,000 to $196,000. So if your income limits are beyond that, you cannot contribute to a Roth IRA. And the contribution limits are the same as for the traditional IRA. You get $5,500 per annum plus the $1,000 catch-up for age 50 and over. So the Roth IRA looks, it has the same kind of setup as the traditional IRA, except that the contributions are after tax and all of the withdrawals are tax-free. I love that phrase. The phrase tax-free is applied loosely far too often to stuff that's really tax-deferred, but a Roth that's truly tax-free. Yes, sir?
My understanding that the Roth does not have age restrictions.
The comment relates to the Roth not having the age restrictions that the regular IRA has. I don't recall off the top of my head if that's true or not. I'm sorry, I can't give you an answer on that. There's another question back here.
Now, I have two questions. First question. On the limit shown on your slides, there were earnings in 2016 and contributions by April 15, 2017, or for earnings in 2017 and contributions by April 15, 2018.
The question relates to whether the limits that are shown on earnings on the slides relate to contributions made in 2016 or up to April of 2017 or for a year later. The answer is the numbers that I've given you are for they're the latest 2017 numbers, and you can use those numbers up to April for contributions up to April of 2018. However, the numbers for 2016, the prior year, are very similar. They're about $1,000 or $2,000 less in fact, I think in some cases I've given both numbers. Another question?
Second question, do R&D calculations include Roth assets in addition to non-Roth retirement accounts?
The question is whether the RMDs for Roth accounts include only Roth, or do they include other non-Roth retirement accounts. I'm not absolutely certain on that, but I think you're going to have to compute the RMD for your tax-deferred retirement accounts separately from any of the. Oh, I'm sorry, I know the answer to that. There are no RMDs for Roths. I'm sorry, it's easy. Roths have no RMDs. That was a trick question. You almost caught me on that. Okay. It's been a long night. Yes. I'm on slide number 31, madam. Oh, on some of the question of what slides we're talking about relating to some of the limits. On some of the earlier slides, I had limits down for the income that was allowed, and the question related to whether those were limits for 2016 or 2017. Some of the earlier slides. Okay, so for a Roth, the contributions are not deductible, and growth within the plan is tax-free. The other one is you withdraw the contributions, the principal, at any time. You don't have to wait till 59 and a half to do it. Qualified withdrawals are tax-free this is of the earnings, after age 59 and a half, which would be the same as for a traditional IRA. But the original plan must be at least 5 years old to withdraw the earnings tax-free. And again, otherwise there'll be a 10% penalty. And the 10% penalty is waived under certain conditions, and, like purchasing your home or from first home or for medical expenses and stuff like that. Major differences between the traditional and the Roth IRAs. Obviously, the contributions to the Roth are not deductible, as are the ones for the traditional IRA. Withdrawals from the Roth are tax-free, clearly and cleanly. Absolutely, what the fine print says. Whereas, obviously, from a traditional Roth, you're going to be taxed or from a traditional IRA, you're going to be taxed at the ordinary income rate. RMDs do not apply, as was pointed out here, for the Roth IRAs. Roth IRAs make a very good estate planning tool because you can pass them on to the next generation or even skip a generation, and they will continue to grow tax-free to the heirs, and withdrawals, even for the heirs, if they continue to stretch it out for another 20, 30, 50 years, the whole bunch of it can be withdrawn tax-free. I would make the point in passing here that it's on a later slide. Let your heirs know about this so that they understand what they're getting and don't think that this is a windfall and go spend it and forfeit the big advantage of it. Roth conversions. You can convert a traditional IRA to a Roth IRA, and when you do that, you're going to owe taxes on the deductible portion of the traditional IRA, that when if you deducted the taxes going into the traditional IRA, when you pull it out of the traditional IRA and stuff it into the Roth, you're going to pay taxes on that amount. One trick that a lot of folks use, it's a little bit of work, but I think it's well worthwhile, at least considering, is that when you're making your conversion from a traditional IRA to a Roth, that you split it up into 2 or 3 pots and convert, part of it as a fixed income, put a third, or whatever percentages you want, but split it between different asset classes, for example, fixed income, domestic equity, and international equity. The reason for that is because when you've made your Roth conversion, at any time up to, and there's a limit, if you don't like what you just did, you can go back and undo it. And that's known as recharacterizing your Roth. And some of the reasons why you might want to undo it, well, let's go to the next slide that talks about. If you made a conversion to a Roth and you paid the taxes on what went into the Roth, and let's just say that you put it all into some hotshot XYZ fund and the fund had a 50% loss, and you suddenly pay taxes on this big amount, now the fund is worth this. You might say, well, geez, I don't want to pay all these taxes on this. I want to recharacterize this and pretend that I never made the conversion and save paying the taxes, then you can do it afterwards at the lower rate and pay lower taxes. So that might be one reason why you'd want to recharacterize. Another reason why you might want to recharacterize would be after the fact, when the April 15 deadline rolls around and you're doing your tax returns, you find that you've bumped up a bracket, and part of the problem is due to the Roth conversion that you did, which shows up as ordinary income tax on your 1040. You might want to say, well, it's a shame that I converted $100,000. If I'd only done $50,000, I could have stayed in this lower tax bracket. So you might want to recharacterize some of it. The magic of the recharacterization is that it can be done any time up to the date that you file your tax return, and that can be including the extension. So what that really means, if you stretch it to the absolute limit, if you made a Roth conversion today, the middle of January 2017, you would have not just till April 2018, you would have until October 2018 to decide if that was a good thing to do or not. And if in the summer of 2018 you decide, that didn't work out so well, you still have the ability to go back and exit out, to recharacterize it and say, I want to undo that one. So that's the reason for splitting between the two, three or more different asset classes, is because some of them may do well and some of them may not, and the ones that don't you may want to recharacterize and think about doing later. Yes, sir.
I don't understand Rollover too. I mean, we should recharacterize the same old tax bracket. How is recharacterization going to affect your income?
Well, let's go back to look at the question was, how does recharacterization affect the income, as shown up on bullet number 2 on this slide. When you do the initial conversion, let's say you converted $100,000 from an IRA into a Roth IRA. When you do that, you've just added $100,000 to your ordinary income on your 1040. It's a $100,000 tax liability. If when you're doing the paperwork for your 1040 in April, you decide, well, gee, it's a shame I did $100,000. That's bumped me up a tax bracket. I didn't want to be in this bracket. If I'd only done a third of that or half of it, I could have stayed in the lower tax bracket. It gives you the opportunity after the fact to back out some or all of the conversion you did and recharacterize it.
In other words, if you made a mistake planning your very good to get a chance to go back.
Yeah, the comment is whether you get a chance to go back in and undo a mistake. It's actually not even a mistake. I mean, it's just in April you've got a lot better data than you might have done in the previous June or July or whatever when you're making the conversion. Yeah, I mean, and when you're doing the initial conversion, you're doing it based on projections that may or may not come out. And by you're doing the return in April, you have the real data. So if you really look at putting it to the limit, you get a 21 month time period where you can look and see if you made the right decision or not. If you start early in 1 year and then wait, you keep the option open by filing an extension the next year, wait until October to decide whether you want to recharacterize or not. The question is to go over again the items on the previous slide of splitting into the three asset classes that I showed here. There's nothing magic about the three asset classes I've shown here. All I'm suggesting is that if you are going to do a conversion, you might want to consider, instead of putting it all into one single Roth IRA, taking the principal amount that you want to convert and splitting it into 2 or 3 or 4 different Roth IRAs and invest those different Roth IRAs each in a different asset class, so that months or even a year and a half later, you can look at those Roth IRAs and see which of them have appreciated and you made a good decision. And after the fact, you can see which ones you wish you had not done and want to redo, so you can undo those ones. So the only reason for splitting it up into a number of asset classes is to allow you the flexibility to come in and undo some of them if you decide later that with all the benefit of hindsight, now that you know what the growth rate has been on each of those, whether it was a good idea or not.
Well, they're all self-directed anyway, aren't they?
Not the question if they're all self-directed anyway. No, I mean you can get in there with any of these IRA plans, Roth or yeah, I mean, yeah, you can do what you want. You can invest in whatever way you want. You've got the opportunity to within certain limits to invest in whatever assets you want. But the reason for splitting into 2 or more Roths is that if one of the Roths is fixed income and fixed income has gone nowhere, whereas the other 2 have done great, you might want to, or the fixed income has dropped, or it's more likely to be the other way around. Supposing your international equities crashed, you might want to say, well, gee, that wasn't one of that. I don't want to pay taxes on the huge amount that I put in the internationals, and now it's only worth half of that amount. Then you want to have that in the one single Roth where you can recharacterize some or all of that Roth. It just makes it easier to do the paperwork afterwards. Yes.
What do you mean by undo? Now that you have seen the investment is done.
The question is, what do I mean when I say undoing a conversion? The last bullet on this slide actually defines that. When you recharacterize a Roth, you're basically undoing the initial conversion that you made to the point where it looks like it never ever happened. You're just wiping out that action, and it just means that you treat it as if it never happened. And if you do a recharacterization, you can always convert again. There's a 30-day waiting period you have to go through, but after 30 days, you can do another conversion, either the same one or a different one or whatever you want. You're not forfeiting the ability to do that conversion at a later point. I'm going to have to move on because we've got a ton of slides and we've got a lot of ground to cover. On a backdoor Roth, there are ways of funding a Roth even when you exceed the AGI limit set for making contributions to the Roth. The normal way of doing that most people think about is funding a non-deductible IRA and then converting that non-deductible IRA to a Roth. you have to be a little careful here because the IRS is what they call a pro rata rule, which means that when you're taking your so-called non-deductible IRA, if the whole IRA is non-deductible and you have no other IRAs, that's a clean decision. If you have other IRAs and some of them are non-deductible and some of them are deductible, the IRS insists that you pool the whole lot to determine what taxes have to be paid. And you may find that you're paying, if you've got a whole bunch of deductible IRAs out there and they all get pooled, you may find that you've got fairly high taxes to do this. Again, I've said beware the pitfall of rolling old 401k plans into an IRA when you're changing jobs. That'll be one reason for doing it. The general concept that you want to move your pre-tax dollars to a 401k or plan similar to that, because it will not be included in the Roth computation for a conversion, and put the after-tax dollars to the Roth. Question is whether I can give an example on this. The point I'm really trying to make here is that if you want to do a backdoor Roth, it works most easily if the only IRAs that you have are all ones where you've made non-deductible contributions, because that means you've already paid the taxes on those, and it means that everything that you convert over to the Roth has already had the taxes paid on it. Yeah. So, whatever you've paid the taxes on already, it's easier to convert, or certainly cheaper to convert to a Roth. If you have deductible IRAs, the IRS is going to insist that you look at all of those and compute the taxes that were saved that you deducted way back and pay those taxes now before you can convert them to a Roth. The MIRA is something, it's a starter kit for a Roth. It's only been around for a couple of years, I think. It's fairly new. It's kind of like a beginner's Roth, where it's got the same eligibility requirements as for a regular IRA, but they're normally set up as payroll deductions, automatic payments, and the limits are the same. They're set up to, I think Obama put this in place to really encourage young kids or folks that are starting work for the first time to entice them to contributing to a savings account. Your contributions can be withdrawn at any time, with no tax penalty, so that there's no commitment for the folks that put them in. They're portable from one job to the another. And here's the part you're going to love. They only invest in U.S. Treasury savings bonds, and they're guaranteed not to decline. But anybody who remembers one of my first workshops knows immediately there's no risk, there's no, very low risk, very low income. So these are guaranteed never to decline, but I think they pay something like 2% per annum or something these days. And then when the account gets up to $15,000 or before, they have to be rolled over into a regular Roth. But so it's a way for young kids with low income, or for anybody with low income for that matter, to get started with a Roth with very minimal requirements and very minimal investing knowledge needed. I mean, it's kind of like contributing to a savings account. You don't need to to do a whole lot of research or anything like that. So it's a way of enticing people to get started. I believe you need to have income. Yeah. Yes. Yes, you do. Okay, we'll move on quickly to the traditional IRAs, which everybody knows and loves. A lot of folks are familiar with those. 2017 limits, same as 2016, were $18,000 plus another $6,000 if you're over age 50 or over. These are set up by mostly large corporations. They're fairly expensive to set up. but because the company has to run an average deferral test, so that the IRS does not want corporations using these to give their highly competent employees a particular edge. So they have to run all sorts of tests across the full complement of all the employees and make sure that the highly competent employees aren't getting a particular benefit out of it. Typically, the employer makes matching contributions, usually up to a 4% limit. The employer contributions are usually vested, and the employer picks the time, but it's usually up to 4, 5, maybe 6 years. I don't think they're allowed to go beyond 6 years. The employee contributions are always fully vested. Participant loans, some corporations allow them, unfortunately, and that's a personal comment. Some corporations ban them. Do not allow folks to borrow against them purely because of the additional paperwork and hassle and liabilities involved. Even if they are allowed, I strongly recommend that people do not use them because there are all sorts of traps and risks if you do borrow against a 401k portfolio, because first of all, if and when you lose your job or you retire or change jobs, the company is going to require the full loan to be repaid typically within 1 month, maybe 3 months. And if you can't repay it, then the full loan becomes treated by the IRS as a distribution with taxes owed and penalties and all the rest of it. So be very, very careful. I would say as a last resort, borrow against them. Tax characters, question at the back of the room. Yeah, the question is that, if companies offer a 401k, is it a better deal than the Roth? For young folks, I think the Roth is the best thing going. We'll get to it in a minute. There are some Roth 401ks which would have the same benefits. Tax implications for a traditional 401k: you make pre-tax contributions. Earnings grow tax deferred. It's all very much the same as for a traditional IRA, and they have the same RMD at age 70 and a half with the same 50% penalty as for the IRAs. Somebody had asked before about making contributions to over and beyond that to the 401ks. The IRS limits are actually $54,000 plus $6,000 catch-up, but that's not normally happens in practice, but the IRS limits allow it. When changing jobs, I said to roll the pre-tax contributions into an IRA, just be careful with that. That's why the question mark means. Use after-tax contributions to fund a backdoor Roth. One of the issues that comes up, setting up 401k plans is very expensive for the corporation, and there's all sorts of issues with it. Before we get into that, we have another question from the web.
Aside from the deductibility, is a non-deductible very similar to a Roth?
Aside from the deductibility, is a non-deductible very similar to a Roth? I haven't thought. No, the answer is no. With a non-deductible IRA, you're paying the taxes on the contributions, but the earnings are growing tax-free within the traditional or within the non-deductible IRA, but you are going to pay ordinary income tax on the earnings from the IRA. Whereas with the Roth, there will be no taxes on either the earnings or the contributions as you withdraw them. Okay, I've said that it's fairly complicated and sometimes expensive to set up 401k plans for corporations, and most corporations usually have some form of investment committee that looks after all of this, but they have a fiduciary responsibility to the employees, to the kind of folks making the contributions, and they don't always take that as seriously as they should. The purpose, the corporation by way of the committee or even outside it, is responsible for selecting the service provider. Do they go to a Vanguard or T. Rowe Price or Fidelity? Who are they going to use for their plan? They have to understand where all the hidden fees are, and there are sometimes very heavy hidden fees and kickbacks and all sorts of under-the-table stuff that goes on, and the corporation needs to be on top of all of that, and they need to provide a good selection of investment vehicles so that the employees can put together a well-balanced, diversified portfolio themselves, or at least have the opportunity to do that, even if they elect to do otherwise. And not all companies take these responsibilities as seriously as they should. And I hear all sorts of horror stories about folks who are in a 401k at work, and the only options they have are mutual funds with high expense ratios and stuff like that. They don't have the kind of exchange traded funds, the low cost index funds and some of that available. And no matter how much they beg the corporation to include these, they may not always follow. This has triggered a number of lawsuits recently, which should be the last resort. I mean, you should certainly discuss it with the company first. But over the last couple of years, there have been numerous lawsuits. Boeing settled for over $57 million when there's a class action suit by their employees that said you didn't provide us good opportunities, good options for our 401k, and that's cost us. Lockheed Martin has similar $62 million. So you read about these all the time. I just picked those two out because they made the headlines. 403b plans are very, very similar to 401ks, except they're usually used for not-for-profit organizations, for local governments and educational groups, and teachers, firemen, etc. But in almost all regards, they can be treated the same as 401ks. There are some minor differences, but it's beyond what we're doing here to get into those. You can also get, this lady at the back we discussed a few minutes ago, you can get Roth 401ks and 403bs. Not all companies offer them, but they're starting to become more common now, more popular now than they had been, and they're certainly worth looking into if a company does offer them. They behave exactly as you'd expect for a Roth plan. The contributions are not tax deductible, but all earnings and withdrawals are tax-free. In this case, RMDs do apply, so that's the difference between the Roth IRA, where the RMDs do not apply. There's a little bit of a trap here. I believe for the Roth 401ks, the RMDs do apply. Oh, there's an exception. The exception is if you're still working at age 70 and a half with the employer that holds that plan, that's sponsoring that plan, then the RMD will not apply. But if you've already retired, the RMDs will apply even for the Roth 401k. Savings incentive plans, simple IRA, usually set up by small employers. They must be less than 100 employers or less. Employee contributions for both 2016 and 17 are $12,500 per annum plus the $3,000 catch-up. The employer matches dollar for dollar, and he can pick one of two match plans, either 3% of the employee compensation for those who contribute, or a fixed 2% for all employees, whether they contribute or not. And the limits are $5,300 for 2016, $5,400 for 2017 for the employer 2% match. SEP IRAs, Simplified Employee Pension Plans. Small business owners, especially self-employed folks, if you're doing any form of consulting or whatever, it also works well for married couples with a family business. 2017 limits are the lesser of 25% of income or $54,000. So we're talking about serious contributions here. Contribution limits are not affected by participation in Roth in regular IRAs or Roths. Distributions are taxed as ordinary income, so it behaves the same way, and you can convert to a backdoor Roth you know, on a year-by-year basis if you want to move into a Roth. Individual 401ks, I'm going pretty quickly here because I want to get onto some of the estate planning stuff at the end. Individual 401ks are great for sole proprietors or, again, a married couple, because you can contribute as both the employer and contribute as the employee, which means that not only can you make the $18,000 contribution for as an employee, if you're your own employer, you can make a total limit of up to $53,000 for 2016, $54,000 for 2017, and if you add in the the catch-up, it goes up to $59,000 and $60,000. Somebody had mentioned the non-qualified plans. I've got this slide in there. I really don't want to spend any time right now because I don't have the time to go into the details, but there are some non-qualified plans out there. Normally, the IRS has some restrictions on it, but there are, the employer puts even tighter restrictions usually because they want to use these as golden handcuffs, so they may set up rules that you can't start and withdraw until a certain age and so on. They're also risky because you're taking the full risk of the potential bankruptcy of the company, because these are owned by the company, and if the company goes bankrupt, your plan may go bankrupt along with it. So be careful. It's not normally an option for most of us, but just for the sake of completeness, I want to include it here. For those folks who have a number of different options, what order should you fund these in? The one rationale says you take the free money off the table first by funding your traditional 401ks up to the match limit. I mean, it's free money, why not take it? Then you contribute to a Roth, and that's particularly true for those folks who are younger. You can look into doing a backdoor Roth. Finally, go back to look at adding to the 401k over and beyond the initial match that you put in as number one, and then do the step of the traditional IRA, and finally a taxable account. I put in the numbers here for 529 tuition plan, not that it's a retirement plan, it's really outside the scope of this, but so very, very similar to the Roth stuff that we talked about before, but just for the sake of completeness, I put it up there. I'm not going to go through it now. Question you very often get is, should I fund my retirement plan or my tuition plan first? My response to that is another question. When was the last time you applied for a loan to fund your retirement? It's easy enough to apply for a loan to fund your kids' college education, and there's all sorts of folks will talk to you about that, but no one's going to give you a loan to fund your retirement. And also, there's no guarantee that your kid's going to go to college anyway. The normal rule is that you set your you fund your emergency fund first, 3 to 6 months for most people, minimum. It could be longer under certain circumstances. Yes, sir. The question is, if you've been funding in the 529 plan for your grandchild for all of these years, and then he decides not to go to college, what happens to the money? I know that the money can be transferred to a different beneficiary as long as they use it for educational purposes. I'm not sure that there are any options beyond that. I don't know what. I think you'll probably pay taxes on it if you use it for anything, serious taxes on it if you use it for anything other than the education of somebody. You can use it for your own education. Yes. Emergency fund first, then your retirement plan, and as we looked at earlier, I'm suggesting 15% of gross salary minimum, and college savings would come later than that because there's all sorts of options to fund that. Asset location, as opposed, we talk about asset allocation in workshop 2. For asset location means what assets should you hold in which accounts. We got tax efficient products, which are things like munis and index funds and so on, which spin off very little in taxes and generate qualified dividends, long-term capital gains. Those should generally go into taxable accounts. There are tax inefficient products like corporate bonds that can give you non-qualified dividends and short-term capital gains. And those are best in tax-advantaged accounts like IRAs and Roths and so on. Some of this can set up rebalancing challenges, because if you have a taxable account, you're probably going to want to have the pie chart with such and such a percentage in large cap growth and small cap and fixed income and all the rest of it. And then you've got an IRA over here, and it's got a similar spread of stuff, so you've got some duplication back and forth between the two. It's not easy to set up to put the inefficient products into the tax advantaged accounts the way you might otherwise want to do, and there's a conflict in how you do that. With a question.
So on some IRA, if you have two businesses, and you have two stocks with up to $54,000 each, or it was $54,000 constrained across all per individual per year, regardless of how many stocks. Yeah.
The question related to SEPs, and if you've got two businesses, the limits apply to each of them separately, or is there any room to move on this? That's way beyond my scope, and it's way beyond anything I'm prepared to answer now, so I'm going to sidestep. Sorry, see a professional. I don't know the answer to it. It's a simple question. Okay, one compromise for rebalancing is to overweight your tax-deferred accounts with the fixed income and overweight your taxable accounts with the equity. Supposing, just for argument's sake, you had your IPS, your investment policy statement, said that you'd agreed you wanted 40% fixed income and 60% in stocks. For your IRAs and stuff, you might want to change that to 60% in fixed income and 40% in stocks, and then for your regular taxable accounts, weighted the other way around. It's just one compromise to make to allow you to do some rebalancing and get some of the benefit of having the right location for the various issues. Now, Morningstar is a different solution, or it takes that solution a little bit farther, I guess, to the limit. Morningstar suggests a strategy where you look at all of your portfolios as a household account and do the asset allocation on that household account. And when you've got that all figured out, you start by taking your taxable accounts and you fill that up with the tax-efficient investments, typically U.S. equities and stuff like that. You then go to your Roth IRAs and other tax-free accounts and put all the high-earning stuff in there. I guess it's the risky stuff, the emerging markets and stuff like that. That has the potential in the long term to give you the highest returns. But you put those, even though it'd be very volatile, put those into the Roth IRAs, and then finally whatever's left over, the tax inefficient stuff, goes into your tax deferred accounts, into your IRAs. Morningstar claims there's a report recently published. In fact, it's referenced at the back in one of my reading further items. They have a paper which suggests that you can get as much as 1% higher after-tax return by doing this. But there's a fair amount of work involved in doing it. And the other gotcha is, if your IRA happens to be at Fidelity and your taxable accounts are at Schwab or whatever, it no longer makes any sense to compare the returns of the Fidelity against the Schwab, because the Fidelity might be, might be where you have your fixed income, and Schwab might be where you happen to have all of your U.S. equities and so on. So you forfeit the ability to compare one account to the other. It's meaningless to compare them. So you should only look at how the overall account is doing on an after-tax basis. But Morningstar suggests that you can get up to 1% improvement by doing that. So that might be as close as you come to a free lunch from tonight's workshop. For estate planning issues, the federal estate tax exemption has gone up from 5.45% in 2016 to 5.49% in 2017, which means that a married couple can get really close to $11 million in exemption. Now, I'm not going to even start to discuss any of that, but what people overlook on estate planning are the income tax issues. And from the point of view of income tax, you're clearly best to bequeath Roth accounts because they are tax-free, period. The heirs will never be taxed on anything from the Roth. The taxable accounts are good. Strangely enough, the taxable accounts bump up, to number 2 on this because they get the step up in basis, and there's no tax owed, immediately after you inherit them. If you hang on to them for a few years and they appreciate during that time, you roll capital gains tax on that. But taxable assets can be sold tax-free, immediately after you inherit. The worst are the tax-deferred IRAs, because every penny coming out of the tax-deferred IRAs is going to be treated as ordinary income, and you get no step-up in basis for it. If a spouse inherits, and this goes back to one of the questions that was asked earlier, if a spouse inherits an IRA, he or she can do what's called a stretch IRA. It becomes, they can name it in their own name and only start taking the RMDs when they reach age 70 and a half. If anybody other than the spouse inherits it, it then becomes an inherited IRA, and they need to start taking the RMDs immediately. I think it's the next year or within a year. I don't remember exactly. It's within a year of death or something. But it may not be all that serious, because if a 30 or 40-year-old inherits it and starts taking the RMDs, they could have, the RMDs may only be 1 or 2%. They could be very, very low. But there are all sorts of rumors going around that Congress is looking at killing the stretch IRA, and that may not be around for too much longer. In general, IRAs make one good use for the IRAs, if you have any charitable inclinations, is to use those for charitable donations. That even counts as your RMD. I should have underlined in red, talk to your estate planning attorney. I am not an attorney. Inherited IRAs assets. You've got the stretch IRA. Oh, this is what I said before. The spouse has to take RMDs at age 70 and a half. The children have to start taking their RMDs based on their age. And if there are 3 or 4 beneficiaries, the RMDs are going to be based on the age of the oldest. I'm sorry. So the RMDs are going to be higher for the older kids that inherit than the youngest ones. So if there's a broad range, it may be worthwhile splitting the IRA up while you're still alive and giving a certain amount to the oldest kid and a certain amount of the middle ones and the younger ones, so the younger ones don't get penalized by having to take the RMDs of the older ones. Again, it's important to talk to your heirs and let them know about the tax advantages of this, because if you don't let them know, they're going to say, oh great, found money, let me go spend it, and blow all the advantages of the IRA. That's particularly true for the Roths. Even if Congress does mandate, the talk is that they're may well mandate that all inherited IRAs be distributed within 5 years of death. That would include the Roth as well. But with the Roth one, even if you have to distribute everything out of the fund within 5 years of inheriting it, it will be tax-free. But if you get a regular traditional IRA and you have to distribute everything out of it within 5 years, you could find yourself paying significantly higher tax bracket than you were ready for. Yes?
What's the rationale for forcing Roth IRA distribution 5 years and distribute tax income?
The question relates to why the Congress might want to force all the IRAs, including the Roth, to distribute within 5 years of inheriting them, if there's no tax owed on the Roth anyway. I'm not sure there is any rationale other than that they are likely to make just a general law that says IRAs need to be distributed within 5 years, period. Recognize, I'm not saying that's not the current law. That's only rumor. And what the trade press is saying is that that's a possibility that Congress is looking at, has looked at, in fact, at the past, and failed to pass the law. I think it was last year, but it's likely to come up again, and it's likely to keep coming up until it eventually does pass.
Right now, for Roth IRA, if somebody donates to the elder person, he's not a whole lot of cash.
If the question relates to a Roth IRA, if you leave your Roth IRA to anybody, be it a spouse, kids, or the cousin down the street, your neighbor down the street, nobody will pay any taxes on it, period. Regular IRAs, well, all of these plans the assets do not pass by will or by trust. Be very, very clear on that. They pass to the next generation by the beneficiary form that you should all have filled out for them, and no doubt check every year or every 2 years to make sure that they're current, because if you've named the next spouse as beneficiary 10 years ago, that next spouse is going to get those benefits unless you change the beneficiary form, regardless of what you say in your will. The beneficiary forms rule, period. Everybody clear on that? Again, talk to your estate planning attorney. Okay, we've covered a huge amount of ground tonight, and I've gone fairly quickly through a lot of the plans, but you have it in writing in the slides if you need to go back and review it. And it's also on the website if you need to go over it more slowly. We looked at both the accumulation phase and the distribution phase. We looked at the tax-deferred and the tax-free and the taxable plans, and why you should have assets diversify across the 3 of those. We looked at how to at the importance of asset location, and finally at some of the estate planning issues. Again, like I said, all of these are available on the website if you need to go back to it. Next month, we're going to continue with the retirement planning, and we're going to look at managing your cash flow in retirement. We're going to look at the classical 3-legged stool with Social Security, pension, and retirement portfolio. We're going to look at other tools that are available. I've included reverse mortgage and annuities in here because they play into your cash flow, and even though everybody curves their lip a little bit at both of those, in the proper hands and in the proper time, they can be useful. They may in fact make sense for some people under certain conditions, and I want to spend a little time at the end of next workshop to go over those. And I also want to look at 2 other issues that come up. If you've got a perfect plan in place and everything looks great on paper, the question is what could happen to totally shred that and tear it up and set you back. And those are the 2 issues covered with long-term care and with an umbrella insurance policy. And I want to cover, give you some reasons why you should at least give serious consideration to insuring against those contingencies. For those folks who are going through all of these in workshops and diligently doing your take-home homework on it, the question I'm asking tonight are you saving enough? Are you on track with what you have? Again, that may apply more to kids and grandkids than it does to us here. Do you have adequate tax diversification? That's something that we should all be looking at. I suspect everybody's looked at Roth conversions at some time or other. Hopefully I've given you enough information tonight to go back and reevaluate that and see if it does make sense. Have you got the proper assets in the proper accounts, the tax efficient and tax inefficient ones? And finally, last but not least here on this hit list, please make sure that your beneficiary forms are up to date, because what's written down in there is what rules, even if you've changed your mind, or even if you've gotten divorced, or even if some of the folks have passed on or whatever. I've given you a list of further reading here for those folks who want to get into, look a little deeper. I've given you useful websites on here, which I think, you may want to, there's no magic to this. Again, tout the Sanitara Library website, because that really has a ton of stuff that you'll pay very real dollars for if you get anywhere else. So anybody who has a Santa Clara County Library card has access to that. And the cards are free. All you got to do is show up at the front desk and they'll check it all out for you. And my final, what happened here? Okay, I've just gone offline. Okay, my mandatory cartoon at the end is the financial planner sitting down going through all of the details of the plan, and it's just basically gobbledygook. It's Chinese hieroglyphs. Any questions so far? No. But it seems to sum up the way some folks work through it. Any questions of a general nature? Anything we've covered? Anything that I've missed?
Yeah, regarding the Roth IRA, you said that the R&D applies to it. So
No, the question relates to the Roth IRA and the RMDs. The RMD does not apply to a Roth IRA, but it does apply to a 401k Roth.
So from 401k, we roll over into a Roth IRA.
Question is, can a 401k Roth be rolled over into a Roth IRA? I have no idea, sir. I don't know. Do not know. I think we've run out of time, so I'm going to sign off on the webcast. Now, thank you folks for attending. If there are any questions over and beyond that, from here, I'll leave that to go.